Hello, my awesome accounting students. Welcome back for Chapter 9. This is the most important chapter in our entire course this year. So I hope you're ready to learn about how to best manage your cash account. So let's take a look back at where we've been. We've been covering merchandising entities. So think of your favorite merchandiser. And what we've done is we've gone through the selling side of the house. We've gone through the buying side of the house. We have seen how merchandisers make sales on account and how they do purchases on account, also for cash and for credit cards. To finish the cycle up, we need to talk about the cash being either collected or paid. And along those lines, we will be looking forward towards the internal control of cash. So let's get started. The type of cash receipts really does depend on the type of business that we're talking about. So once again, imagine yourself at your favorite retailer. If I choose Home Depot and I were to sit there and watch the cash transactions, I would see lots of registers ringing up cash collections, which means they exchange cash right at the cash register. I might see credit cards or open account receipts taking place. But in any case, at some point, whether it's now or later, cash needs to be collected. So if any of you have ever worked in retail, you've probably had the experience of balancing out your drawer. What that means is at the end of your shift, you count your cash drawer. This could be in the presence of a supervisor or possibly in front of a camera, or maybe even both. And you measure that drawer's contents against the cash register tape. Inside the cash register is a tape that is keeping track of all the sales electronically. So just like you or I would get a receipt if we went through a drive-through, inside the store is another type of receipt being rung up for each sale. So we need to balance out the drawer. Most companies start out with a change fund, which means there's a certain type of balance that starts out in everybody's drawer in order to make cash change for the customers that come through. So we take our cash drawer at the end of our shift, we back out any kind of a change fund that was in our drawer at the beginning of the shift, and this will give us the cash receipts for the day. We compare that against the sales tape, and in all likelihood, there may be a difference. The cash short or over account is used to account for that difference. Let's take a look at how this would look in the journal. In this case, the cash count of the drawer disclosed a total of $2,397. But because there was a $200 change fund sitting in the drawer at the start of the day, that needs to be subtracted. That means our cash for the day was $2,197. That amount is compared to the sales tape in the amount of $2,200, showing that in this case there was a shortage of $3. Let's take a look at the journal entry for that transaction. Cash is increased for the amount of cash received for the day. Remember, this was after the change fund was backed out. Cash went up, so it is debited. Sales is always credited for the amount shown on the sales tape. The difference, in this case a shortage, was debited to cash short or over. Overages do happen as well, but they are far less common. In this case, let's assume our cash count was $2,301. As always, we back out the change fund, in this case $200, leaving us cash for the day of $2,101. That cash for the day number is then compared to the sales tape, and in this case we have an overage of $1. Let's take a look at the journal entry to record the overage. The major difference in this slide is that the cash short or over account was credited for the $1 overage. The bottom of this slide shows entries to the cash short or over. Please note that shortages are debited and overages are credited. At any given point in time, the ledger is tracking the balance. In this case, as in most cases, the balance sitting in that general ledger account is a debit, which indicates a net shortage. Shortages are lumped together with other miscellaneous expenses on the income statement. In the rare case of a net credit balance, that would indicate a net overage, and that would be lumped together with miscellaneous revenues on the income statement. Before we leave the topic of cash receipts, a minor topic in the book is that of a promissory note. A promissory note is a written promise to pay a specified amount of money on a specific date. Most notes require that interest is also paid at a specified rate. Businesses use promissory notes to extend credit for some sales transactions, but more often than not, they are used to replace an old or overdue accounts receivable. Let's take a little bit more of a look at what a promissory note does. Sometimes promissory notes are used to replace an old accounts receivable balance when it goes past due. In this example, on July 31st, Max Out Sporting Goods accepted a 6-month note from another customer who owed them $800 on account. Farley had asked for more time to pay his balance, so Max Out Sporting Goods agreed to grant more time if they signed over a promissory note with a 9% annual rate of interest. The note provides more legal protection than an account receivable. The interest is compensation for the delay in receiving payment. On the date of the transaction, July 31st, Max Out Sporting Goods records a general journal entry to increase the new notes receivable account and to decrease accounts receivable for the face value of $800. Note receivable is a brand new account, and the major difference is it is a formal written promise to pay. On July 31st, 6 months after the note was signed, the amount of the check came in at the maturity value of $836. This included the principal amount of $800 plus interest of $36. Interest is computed by taking the principal times the rate times the time. In this case, the formula is shown as P times R times T. Take a moment to understand the computation, and as always, ask if you have questions. Spend time reviewing the control of cash receipts. Here's a visual just to give you an overview, but this is an important part of the chapter that you need to read. Make sure that only designated employees receive and handle the cash. Bonding is important. You can read more about that. Keep cash receipts in a cash register, lockbox, or in insured accounts. Another good control to safeguard that cash is to have an armored pickup truck pick it up if the amount is large. Make a record of all cash receipts at the source. Before a bank deposit is made, check the funds to be deposited against the record made when the cash comes in. It's best if this can be done independently of the person who recorded the cash. Deposit cash receipts in the bank promptly every day or several times a day. Enter cash receipts transactions in the accounting records properly. The person who records the cash receipts should not be the person who actually deposits them. And the most important cash control that we're going to learn about today, have the bank statement sent to and reconciled by somebody other than the one who is touching or recording the cash. We will learn shortly about a bank reconciliation. That is the most important thing that we will learn in the entire chapter. Control of cash payments is also important. It is important to control cash payments to ensure that the payments are made only for authorized business purposes. Consider the following essential cash payment controls. Make all payments by check or electronic debits, except for payments from special purpose cash funds, such as petty cash. Issue payments only with an approved bill, invoice, or other document that describes the reason. There should be supporting backup, as we looked at these documents in the purchasing process earlier. Make sure only designated personnel approve bills and invoices. Prepare payments and record in the checkbook by someone other than the person who approves the payments. If possible, have another person sign and mail the payments to creditors. Of course, we have electronic transactions now. Consider requiring that 2 people sign the checks for greater than a specific amount. Use pre-numbered check forms and account for every check that's sent out. Make sure during the bank reconciliation process, the canceled checks are compared to the check register. The person who completes the bank rec should be someone other than the person who records and prepares the payments. And of course, make sure that all records are updated promptly for all cash payments. Just as in the last set of controls, the person who records the cash payments should not be the one who approves them or writes the checks. Of course, exceptions are made for small businesses that do not have the accounting staff to be able to ensure these controls, but no matter what size the firm, effort should be made to set up an effective internal control over cash. On to the second part of the cash account. For now, this is Professor Johnson signing out.